Okay, so now we're going to talk about how to ensure long-term survival in the markets. Okay, so we're going to put everything we learned in the previous lessons into this one to make sure you have the proper statistics that you need in order to make a trading model that really works and that is designed to make you money. Okay, so I just wanted to start off by saying markets don't really care about you. They don't care if you need the money to pay your mortgage or grocery bills. They don't care if you are rich or poor, employed or unemployed, okay? What the market really cares is if you're right, okay? You could be shorting the market and the market's been going short for days and months and years, and you can continue shorting and you can be right, right? It doesn't really matter what you think. What really matters is if you're right. Okay, so it's very important to realize this, that markets can remain irrational longer than you can remain solvent. And that's a famous quote by John Maynard Keynes. Right? So markets behave irrationally, and there's really no guarantees whether or not you have 100% accuracy with all your trades. That is impossible to really maintain in the long run, unless if you have some incredible, high frequency robot that is able to front run the markets, like many of the machines are actually doing at this present moment. So unless if you're able to employ that kind of system, you will never really be 100% accurate in the long run. Okay, so just keep this in mind, that no matter what, if you maintain the proper statistics and if you maintain everything that you need to maintain, like the money management, risk to reward, your drawdowns at proper levels, you will ensure long-term survival. Okay, so that's definitely the type of attitude you need to have in order to be a successful long-term trader. Okay, so like I said before, always use a stop loss with your trades and target limits with orders, and at least for the beginning, always try to maintain at least a 1-to-1 risk-to-reward ratio. So this is depending on your strategy. You might employ a 2-to-1 or 3-to-1 risk-to-reward ratio. It all really depends on the type of trader you are. If you're more of a long-term trader, you'll probably need to win less trades, just because you're capturing more pips in the market than a short-term trader. So at the end, always maintain a stop loss, because this is your insurance policy against your own destruction. Even the best traders I've seen always use a stop loss when they trade. So in reality, just like if you would enter into a business deal, like if you want to purchase real estate or if you want to purchase a company or whatever it is, you always have to know what your exit is in mind. And a stop loss is exactly that. It is your exit. It's your exit strategy from a trade gone wrong, right? So just like what you need in business, if you enter into a partnership with a friend, you want to know how do you exit this business deal without really too much damage. So this is basically the same. Okay, so now we're going to go into the risk of failure charts using 1% risk per trade. Okay, so we have a few charts, these charts using different types of risk per trade, and I just wanted to point out here that this is really using putting all the statistics together and making sure how to build a system that is mathematically designed to make you money, right? So in essence, here what we have here is target hit ratio. So this is your win ratio for like how often are you right with your trades. Like you write 10%, 50%, 90%, and so on, right? So the more you are right with your trades, the smaller the risk to reward ratio you can maintain. So if you're averaging a 1-to-1 risk to reward ratio, you need to maintain at least a minimum of 60%. Like 55% is good, but it's cutting it short. You need to maintain a minimum of 60%. So anything higher than a 60% win ratio with a risk to reward ratio of 1-to-1 will have a 0% probability in the long run of a serious account failure. Now, what do I mean by serious account failure? Well, for example, a drawdown of 80%. That is a serious account failure. If you experience 80% drawdown, then pretty much the majority of your account equities is pretty much could be wiped out. Now you want to mitigate that as much as possible, and the way to do that is to have if you're using 1% risk per trade, 1-to-1 risk to reward ratio with a minimum of 60 to 65% win ratio. If you are able to maintain these statistics in the long run, you will be a profitable trader. Now, if you are using a 1-to-2 risk to reward ratio, obviously you don't even have to be right 50% of the time. You can be right 40% of the time. You can be right 35% of the time. However, you still have a 0.7% chance of ruining your account. So you want to have a minimum of 40%, right? And so anything over 40% is what you want to have if you are averaging a 1-to-2 risk to reward ratio, and it goes on. So as you can see, as the more you target as like a 1-to-5 risk to reward ratio, you need a minimum of 25%. So as you can see, you can be right less than half the time and still be profitable in the long run using 1% risk. So now let's look at it when it's a 2% risk. This is now basically the same idea, but using 2% risk per trade. Okay, so we can see here it's a little bit higher now. So obviously because you're risking a little bit more. So if we've seen here it's 0.7, now it's 8. So now if you're using 2%, you really want to avoid 35. You really want to maintain an average of greater than 40. I would say more like 45 to be safe. So so the more you risk, obviously the more you will need to be right. So now let's look at 5%. Obviously, I don't really advocate using 5% risk per trade, but if you are going to use 5% risk per trade, be warned that you are risking a lot more money, and you are actually you should definitely be using less risk than this. But this is just to give you an illustrative purposes that the more money you risk per trade, the greater the target ratio you will need to acquire. For example, see if we here at 55% it was 0, now at 55 it's 1.81%. So you really need to maintain a greater than 60% winning with your trades at using 5% risk. So obviously the more risk you have and the more equity that is exposed, you will need to win more trades. Okay, so this is pretty much it for the risk of failure charts. You definitely use these charts when you first learn how to trade. So analyze. It's great to analyze your trades. Maybe it's convenient to do it on a Friday at the end of the trading week. Put all your trades together. It's either you can use a trading journal where you're identifying your trade setups as well as the amount of risk, the amount of potential targets, so you can get your average R to R at the end of the week, and also with a realistic R to R of what actually was achieved in order to get your win ratio, and also to see how much risk per trade you were using. So you're putting all these statistics together. At the end of the week, you should be able to determine in what quadrant you were in. Were you using a 1-to-1? Were you averaging a 1-to-1 and you averaged a 65%? So if you're averaging, week in, week out in the green section of this risk to failure chart, you're pretty much geared up to success, right? You're setting yourself up to make money consistently every week, and this is what you want to maintain. So definitely use these charts in order to build a trading model that is designed to make you money.